When you hear the word market, what comes to mind? Wall Street? Stock charts? Traders shouting on a floor? But a market is not a building. It's not a screen filled with numbers. A market is something much more fundamental. It's one of the most powerful coordination systems humans ever created. So, what is a market, really? And why does it shape your everyday life, even if you never invest? At its core, a market is where buyers and sellers meet to exchange value. That's it. It could be a physical place, like a farmer's market, or it could be digital, like an online platform. A market exists whenever two parties voluntarily trade. No building required. No stock exchange required, just exchange. If you pay for coffee, that's a market transaction. If a company sells products, that's a market transaction. Markets are not special events. They are constant. Here's where it gets interesting. Markets don't just enable exchange. They generate prices. And prices are information. If demand rises, but supply stays limited, prices go up. If supply increases, but demand weakens, prices fall. This dynamic is called supply and demand. Prices are signals. They tell producers what to make. They tell consumers what to buy. They tell investors where capital flows. In a functioning market, prices coordinate millions of decisions without anyone giving direct orders. That's powerful. Markets also create competition. If one company overcharges, another can offer lower prices. If one product is better, consumers shift toward it. Competition forces efficiency. It encourages innovation. It pushes businesses to improve. This is one of the foundations of modern capitalism. Markets reward value creation. They punish inefficiency, not perfectly, but consistently over time. Now let's zoom out. Some markets trade goods, others trade assets. Financial markets allow people to buy and sell stocks, bonds, commodities, currencies. In the United States, one of the most well-known financial markets is the New York Stock Exchange. But even that is just one example. Behind every financial market is the same principle. Buyers and sellers exchanging value based on price signals. The stock market is not a place where companies get rich overnight. It is a marketplace for ownership. When you buy a stock, you buy a small piece of a company. The stock price reflects expectations, not just current profits, but future potential. That's why prices move constantly. Markets are forward-looking. They price in expectations about growth, risk, and opportunity. And sometimes those expectations are wrong. Here's a common myth. Markets are perfectly rational. In reality, markets are made of humans, and humans are emotional. Fear and greed influence decisions. Optimism drives bubbles. Panic drives crashes. But over long periods, markets tend to correct themselves because eventually fundamentals matter. Revenue matters, profit matters, productivity matters. Markets may fluctuate in the short term, but over time they reflect real economic value. Remember what we said about money? Money is trust. Markets depend on trust too. Trust that contracts will be honored, trust that transactions are secure, trust that rules are enforced. In the U.S., institutions like the U.S. Securities and Exchange Commission oversee financial markets to maintain fairness and transparency. Without trust, markets collapse, because no one wants to trade in a system they don't believe in. Even if you never buy stocks, markets affect you. Interest rates are set in financial markets. Housing prices reflect real estate markets. Gas prices reflect energy markets. Your salary is influenced by labor markets. Markets determine opportunity. They determine cost of living. They influence economic stability. You live inside multiple markets every day, whether you notice or not. Markets reward value creation, but they also reward ownership. If you only participate as a consumer, you pay prices. If you participate as an owner through investments or businesses, you benefit from rising value. This is why understanding markets is essential, because markets don't just determine prices, they determine who accumulates wealth. Participation matters. So what is a market, really? It's not a building. It's not Wall Street. It's not just stock charts. A market is a system of voluntary exchange, a system that coordinates millions of decisions through price signals. A system built on trust. When you understand markets, you stop seeing prices as random. You start seeing them as information. And once you understand that, you can decide how you want to participate. In the next video, we'll explore something even more personal: debt. Because borrowing money is one of the most powerful and misunderstood market transactions in modern life. Subscribe if you want to understand the system from the inside out.